Well, with more, we're now joined by Armine Yalnizyan. She is an economist and Atkinson Fellow on the Future of Workers, and Pedro Antunes, Chief Economist with the Conference Board of Canada. Hello to both of you.
Hello, Michael. Hi, Pedro.
Hi, Armine.
So, Armine, you know, the Bank of Canada rate, as we said, remains unchanged for now, but they do hold out the possibility of more rate hikes down the road. Just how far down the road are we talking about? What exactly are they watching out for?
I think there's two things they're watching out for. First of all, how far, how fast will the Federal Reserve go? Because what happens in the United States affects the value of our dollar and consequently the inflation that we import with the goods that we purchase in American dollars. And the second thing they're looking for is the pace at which the Canadian economy responds to the 8 rate hikes that they put in place in 2022. They have said repeatedly that it takes between 18 and 24 months to see the full impact of those rate hikes. And we're nowhere near that yet. So I guess they're watching to see how far the economy cools. You know that in the last print, we hit 0% growth. And so everybody's looking for that mythical soft landing where you drive up costs, but you don't trigger a recession. And so far, so good, but you never know when the pain point starts being felt.
Yeah, absolutely. You know, Pedro, it's interesting because, you know, the consumer prices have dropped since last summer when inflation hit that 4-decade high. But, you know, CPI still up year over year. Core inflation is still above the bank's 2% target. So that said, and given what we just heard from Armine, will the bank really have any other choice but to raise rates again? Should the debate really be when rather than if?
Well, no, I agree with Armine. I think a lot of the final decisions will come down to not the success here at home necessarily, but what happens in the U.S. And I think in the U.S. they're having more problems. And as we just heard, they're now suggesting that they may raise rates south of the border. I think otherwise, if the U.S. is successful, if we do see, for instance, in the next report from the U.S. Inflation coming down more successfully, then I think the monetary policy in Canada can stay where it is for now. As Armine pointed out, it takes time before we have the full impact on consumers. We know that households in Canada are much more indebted than the U.S. We take 5-year terms on our mortgage typically, and so before the full pain of these increases is felt, it's going to take some time. So I think a wait and see is the right approach right now for Canada, and hopefully, if we are successful, the next move will be one to lower rates and allow us to see some growth again. Okay,
I'm going to pick up on that one a little bit later, but you both have raised now the United States, and of course the U.S. Fed Chair Jerome Powell, he was testifying yesterday in D.C. He continues to testify today, and he is, as both of you point out, preparing the U.S. for a rate hike because he's concerned about loosening monetary policy too quickly. He says history shows us that it bites us if we do that too quickly, and he doesn't think the job of taming inflation is quite yet done. So Armine, how should Canadians interpret that? If we are watching the U.S. very closely, what does that mean for us?
I think there's a bigger issue that's going on right now, not only in the U.S. and Canada, but in Europe, where there is a kind of rethink of whether monetary policy and hiking rates is the right formula for taming inflation. Inflation has come down since the summer. It's not because the Bank of Canada raised rates or any central bank raised rates. The number one thing that has led to inflation coming down is energy prices falling from where they were last summer. They're starting to go back up again now that China has reopened its economy, and we're not seeing any benefits of higher rates on the number one thing that eats up our budget, which is housing costs. In fact, the central bank policy of raising rates is making it more expensive for housing costs, whether you've got a mortgage or whether you're renting, everywhere in the world. So we understand that the formula is you raise rates to cool the economy to let supply catch up, but supply in oil and supply in food has got nothing to do with what central banks are doing. And there was this word that the central bank governor used last rate announcement, humility. And I think there is this moment of rethinking, okay, yeah, central banks are tasked with, they've got one job, price stability. And did they miss the mark? No, they didn't. We have a pandemic and a war. So these things are not the sort of things that you normally guide an economy through. This isn't an economic cycle. This is a once-in-a-lifetime experience of opening and then shutting an economy and then reopening it again. So there's huge amounts of supply shocks that central banks cannot control. And add on top of that a war. So I think there is a legitimate rethinking. What is the role of monetary policy here? And how much further should we be raising rates if you're really not doing anything to help supply catch up? All you're doing is raising costs and putting people out of work.
Well, Pedro, I'm wondering how you would respond to that, because Armine is saying this, but again, at the same time, we're seeing Powell believing that you still have to keep raising interest rates because he's using the traditional route in terms of trying to control inflation.
Well, I mean, there's no doubt that I do believe monetary policy will still work. I mean, it is affecting some aspects of inflationary pressures. It's certainly the commodity price shock that we saw was something on its own. We have seen, for the most part, commodity prices come back down to pre-Russian invasion levels. I'm hopeful that we'll start to see that filter through all the way to the retail, especially when we're talking about food prices, all the way to the retail level. But the other piece on the supply side, it's very interesting because, I do think there's a supply side issue. The reason that we're seeing central banks panicked, and in fact, central banks all over the world panic, is that we've stimulated an awful lot of income into the economy through this pandemic, and now we're having trouble getting essentially supply to catch up with demand. And there's where I differ perhaps on some other viewpoints on the labor market strength that we've seen in recent months. I think a lot of that labor market strength is essentially due to really a surge in immigration that we've had over the past year that is allowing employers now to essentially catch up with the demand, essentially fill those job vacancies that they've been desperate to fill to help catch up with demand. So I think on the supply of services side domestically, that's a positive as well for inflationary pressures.
Okay. Well, let me pick up, before we run out of time, let me pick up on the one point you did make earlier. You believe, you at least stated that we could be looking at lower rates down the road. What type of timeline are we actually looking at, Pedro?
Well, I mean, obviously, everything will depend on inflation, and not just inflation in Canada, but inflation in the U.S. will be very important. But if we are to believe that the full impact on households will be felt in the next 12 to 18 months, then possibly we'll start to see some easing on that brake pedal at the end of this at the end of this year. In our forecast, we actually have our thinking is at the beginning of next year. But yeah, it'll depend on the success, of course.
Mm-hmm. Quickly, Armine, what do you think?
I think it's unlikely to see a reduction in rates because I don't think we're going to easily get to that 2% target, and I don't think they'll ease up on rates until they come closer to their 2% target. But we've got so many headwinds in reaching that 2% target that I don't see any signs of interest rates coming down. And let's not forget that we've just come out of about a decade of the lowest interest rates, not in the last 20 years or 40 years or 100 years, but in thousands of years. It was the most bizarre period of free money that was available that distorted markets. And it is time to have those rates higher. The question is, how much lower can they go to feed the need to grow the economy faster? I don't know the answer to that.
Okay, well, we're watching. Armine, Pedro, thank you for this. Really appreciate the time tonight.
You're welcome.